Hi everyone, this is June from Turning Point Life Investment, and it's the week ending in July 19th, 2008. As always, let's take a look at the market from a broad perspective. First, here we have a monthly view of the SPY. So from our last analysis, we said that the market has been trading above its 20 and 50 month moving average, and this first month, it's the first time that it's been trading below both the 50 and the 20. On Friday, we closed with a doji candlestick right above 120 support. Expect to see prices hover around the 120 area for the time being. Let's go ahead and take a look at the weekly view and see what's going on. From here, as you can see, prices ended with a hammer this past week. All right, this is a hammer candlestick. It was expected to see some kind of relief rally after 6 weeks of decline. And guess what? It was right at 120 support, as we mentioned from the last analysis, right at 120, which is a round number, of course. Now, what I expect to see happen is prices will probably rebound a little higher, meeting the 20-week moving average. So it just kind of meets, basically go back to the center. Volume was pretty high, especially with the hammer candlestick. So that tells us that 120 is a pretty good support, at least for now. And probably it'll get tested a couple of times before, if it does break, it'll probably get tested several times first. Okay, let's take a look at the daily view and see what's going on. If you haven't noticed already, there's a pattern to our analysis. We go from monthly, weekly, daily, and then ultimately to an hourly view. And that's something that you want to do with your own analysis, is to look at stock or the market from all different time frames so you can get a different perspective of the market, rather than just one static daily view, for instance. Okay, so speaking of daily view, here's our daily view of the market. Once again, 120 was great support, created a bullish engulf, and currently its prices are ending right around the 28-day moving average with a doji candlestick. Stochastic is moving higher, and the MACD is also turning positive, so it's slightly bullish, as you can say. I don't think prices will stall right here. I think there's a little bit more room to go, probably back up to the 129 area. If we bring up the Fibonacci retracement, you will see that 129 is right where the 38% retracement is. So typically corrections will get back, a weak correction will get back to the 38%. A stronger correction will probably get back to the 60 to probably even the 50% correction. But currently, I don't see any reason why the market will rally back up to 62% right now. Okay, and lastly, we want to take a look at the hourly view. Now, we mentioned before that if you look back how the 50-hour moving average was great resistance and a great entry point into the puts for the SPY. But recently, on Thursday, actually, prices actually pierced through both the moving averages, and it's kind of using it as support right now. It's kind of trading along. Another reason why we think that there's another leg higher is if you look at Thursday and Friday's price action, it looks more consolidating in nature than a reversal. So consolidation always means that it's resting for another leg move. In this case, it would be higher. So when we look at resistance, we will see, look back to see where potential points are. Right here around 128 is potential good resistance, and always back here, gaps are always good resistance support levels. So right around 131 would be another level of resistance if this first level breaks. Okay, and if once prices start to roll over, then we start looking for entry points into puts to be able to trade the SPY to the downside. And last but not least, we want to look at the VIX, which is the volatility measurement for the S&P 500. As you can see, prices pierced 30, usually 30 and above. It means extreme bearishness, and we had a brief moment of extreme fear, as you can see in the market, right on, I believe that's Tuesday. Created a doji candlestick, and it followed by a large dark bearish engulf to follow afterwards. Okay, currently prices are basically back in the mid-20s, back in the mid-range. So really, it's not really telling us much, but there is still a nice uptrend to this VIX, which basically translates to a nice steady decline for the market, the S&P. Okay, stochastic is pointing down, MACD is pointing down. So if anything, I would expect to see some kind of support around the VIX, around this area, when the market does start to fail, then the VIX should pick up again. And one more thing I want to look at is the open interest. This is the open interest, which means the amount of open contracts for the S&P 500 or the SPY for the month of August. Here are your strike prices. This is the calls on the left, right? These are the call open interest for each strike, and this is the puts. One thing that really does pop out is the 120 strike level for the puts. We have really high amounts of open interest here. So once again, this further proves or shows that 120 is going to be a pretty good support level for the time being. So we might get tested if the market does decline. 120 will get tested a couple of times before it does actually break. And there's really nothing that stands out from the call side. Right here, 123, 125, probably minor support levels, but 120 definitely is a really good support level from what we can see so far. Okay, and that pretty much concludes this week's analysis. We'll talk to you soon again next week.